All right, so welcome to the review session for accounting and finance exam. The goal of this next hour is to just review through some concept that hopefully should be familiar, to give you an overview of what's going to be covered. If you've been studying already, hopefully this will look a bit familiar. If you haven't studied, this is a start to what to study for. I'll touch on most of the topics, but I'll spend most of the time focusing on the example with the pro forma projection, which is going to be a huge portion of the exam, but it's not the only thing on the exam. The other topics, I will quickly go through them, but the focus of this is going to be on the one example of the projection, which you guys have as homework 11, and I have here an example as a homework 10 from a previous year, but everything's the same except some numbers. So that's why I have the other file that'll go along with this. And right now this is on Courseworks. And when it's all said and done, this file along with this file, I'll put it together so it won't be confusing as to which file goes with what. So, the idea here is just to go through some of the important concepts I think that are the crucial to know for this final exam. So everything here hopefully will look familiar. The idea of the snapshot terms and period terms, this is stuff we've been working through this beginning of the semester, but just for this example, since it's so important, we're going to take a quick stab at it. And then when it comes to the pro forma projections, one thing to remember is to figure out which of the terms don't perform as a percentage of sales. Those are the exceptions. The other ones are more straightforward. And the last two situations, the time value of money and the project evaluations, that's the first few concepts of this period. Since the last exam, that's going to be on this final exam, but we're not going to spend too much time on it. Just going to give you these other things that hopefully it should look familiar, and we're going to spend most of the time on the example. So, again, agenda today, go through this example and briefly touch on other stuff. Okay, cool. So let's get into it. So here's a quick just thinking example in terms of hopefully everything on this page you'll recognize, and that hopefully everything on this page you'll recognize as well. Seen them in examples, worked with them, calculated, and so forth. But here's the question. What's the difference between the terms on this page and the terms on this page? So the idea we're trying to get at here is that some terms are snapshot terms. Everything on the first page, those are items from the balance sheet. Accounts receivable, note receivable, and everything from cash, note payable, and so forth. And then what we saw on the second page was items that you would see from an income statement, like net income, PIC, dividend, or the type of costs. And hopefully it was evident from the first exam that everything you see on a balance sheet is taken at a period of time. You have the accounts receivable as of today, May 12th, versus net income, usually explain net income for a duration. So the net income from January to April of this year and so forth. But then there's also the idea that everything, all these terms here, net income, PIT, dividends, you can have the equivalent of it on the balance sheet, which is the cumulative since inception. So a net income on the balance sheet, which you have seen in the past, that's the cumulative net income from the beginning of a company until now. So in a way, that is also taking a period since from the start to the end. But it also, if it's on the balance sheet, it's just saying at this point in time, what's the net income? So all these equity terms, if they're on a balance sheet, they're no longer referring to this past quarter or this past year. Think them as snapshot terms. On the other hand, this might not be as common, but if you see a change in one of these snapshot terms, change of cash, change of debt, then when you take two snapshot periods and take the change, then you have a period term, just like you have a change in net income through a quarter. So you can have the end of period cash subtracted by the beginning of period cash, and that delta cash term is, say, the change of cash in a quarter, similar to what you would find in the cash flow statement, so the change of cash. But you can also have that for debt or any of the things you find on the balance sheet. So the idea of this, hopefully, is just to remind you that you don't want to be confused with period, or you don't want to be confused with terms that are defined for a moment in time, which are the snapshot, versus the ones that refer to a period of term. And the most confusing are the ones that are in the income statement, like net income, or funds you would find in the equity part of the balance sheet, like the PIC dividend. The other ones are pretty clear on what they refer to, but it's these ones that are going to be important when we do the projections. So that's why I wanted to take this time to make sure we don't get confused by them. And given that, then here's just a quick thinking example for if you have an income statement given here for each of 3 years, and if the quick mental exercise to figure out what's the change in net income for each of the 3 years, what would it be? So this is the income statement, and these are the numbers for the net income at the end of each year. So if you're ever asked what's the change in cash, that's pretty evident. That's the change in cash during each of these years. Same with debt. And then when you get to net income, then if you take the two balance sheets from the start to the end, the difference is what you would find on the income statement. So the idea is that the change in net income for 2010 is the number you see on the income statement, because the income statement is the cumulative change during a period. The 200 and 300 here, that's the change in the net income growth, or the change in net income from one period earned to another, which is not how much net income has changed during this period. So here, just remember that the numbers you see here in the income statement refer to the change in net income for that year. So we've seen this before with this equation, equity being the sum of PIC net income and subtract dividend. So what we can do is then we can add the delta before each of the terms, and this would still hold true. So then now we have to really understand what this means, because we're going to use this equation soon forth. So it's for all of these terms, it's for the change for those terms in the year ending in particular year. And when we say net income for the period ending 2010, well, this is the number you would find in the income statement for the year 2010. Same with if you have the change in PIC and the dividend. This is the change that happened during that year. So keep this in mind as we go to the example that this is the example of the pro forma projection that I have put on Courseworks right now. If you want to follow along. So this is what it looks like when you get an example like this. A lot of text, and what you really need to do first is to figure out which what things here are actually important. And anytime you see any numbers that tell you what to do with any of the terms, you should keep them highlighted because you'll need to use this information. So for here it says the sales are going to grow at 10%. Total debt will be constant. Cash will be held at a percentage of sales. They specified this one because cash doesn't always follow this rule, but in this case it follows this rule of being a constant proportion of sales. No dividend. The idea of all these projections is that you're solving for something at the end, whether it is cash, debt, or in this case, you're solving for PIC. How much equity do they have to raise this year to make everything else balance out? Other times we might be asked how much cash can they do they have to retain at the end of the year, or how much debt can they have. Anytime, as long as you have one unknown, you can solve for it because you have enough equations. So this is what you start out with when we do these examples. And so the first thing we do with these projections is to do the sales growth, because without this number, none of the other numbers would be correct. A lot of the other numbers use this new number to project. So when we have an example here, so it's the total revenue for the next period. That's the first number we're gonna solve for. And usually they tell you what this number is because all the other assumptions are based off of this. So here they said the sales growth is at 10%. So you just take 10% more of 50,000 and that's your new sales figure. And make sure, again, double check this number and make sure you have it right, because all the other ones will use this 55,000 for their own calculation. Okay, so we got the revenue for the next period. Now we have to figure out everything else here on the income statement. We're going to go through the ones that are simple first, the ones that follow the rule that they are projecting as a constant percentage of sales, and then we're going to go back to the ones that have exceptions. So a lot of the terms, whether it's cost of goods sold or SGA, other expense, a lot of them just follow the rule that they're going to be a constant percentage of the revenue. So what we're going to do is, say for SGA, we take the percentage of 6,000 divided by 50,000, and that's the same percentage we're going to have for the next period. But for the next period, since we have a different revenue figure, the figure for SGA is going to be different. So that's the idea with these projections. So roughly speaking, this is kind of taking a step back to see what we need to do, is that we want to complete one period at a time if there are two different periods that we're going to calculate. And that's because for the second period, you might need some information on the first period. So it's better to get everything done for one time period before moving on. And as we said, we're going to need to identify the items that don't follow the straightforward rule, but we want to complete them last because we want to get all the other straightforward terms out of the way. And then we've seen this equation. And then we're also going to use the identity for the equity being the sum of PIC plus net income minus dividend. So we need to use those two equations to find whatever the unknown is, in which this case it's the PIC, but we'll get to this part at the end. Any questions before we go forward with procedure? And again, I'll be sending out this slide, so you don't have to copy down every single word. So which terms exactly don't project as percentage of sales? The first 4 ones here, you definitely should know of because they always follow their own rule. And if you ever lost on why or thinking about which ones they are, just think about the nature of what these terms are. Depreciation, how much your items depreciate depends on how much stuff you have at the beginning of the period. So that's not going to depend on sales. It's going to depend on how much PPE you have. Interest, you pay interest on debt. So depending on how much debt you have, that's going to determine your interest expense, not revenue. Tax expense, that depends on how much you made before tax. So EBT, earnings before tax, that's going to determine what's the tax expense. And then the PPE itself, PPE is something that you decide to purchase, and then depreciation wears some of that off. So that's going to have its own rule with that. And then anytime you see words like held constant, set to 0, and so forth, in which case we had, in this example, we had debt being held constant and dividend set to 0, and so forth. That's why it was important when we first had the example here to highlight these, to know that for this example, that's what we're going to do. And then lastly, of course, what's not going to project is whatever you're solving for. That's the last term we're going to do. But everything else here, for the most part, follows the idea that it projects as a constant percentage of sales. So we're going to do those first because they all follow the same rule, which also makes it more important that we got this number right. Okay, so we kind of talked about this already, but what you do is to take the previous period. So this comes from here. You take, for example, cost of revenue. It does project as a constant percentage of sales. So we see what that percentage was for the most recent year. In this case, it was 70%. So we're going to assume that for the next period, COGS is also going to be 70% of sales. And then once we get this number, which is the first part, then we can say, since we know this figure of 55,000 already, 70% of that is going to be 38,500. And that's going to be our new COGS figure. And in the middle here, which you would find in here in the example, we want to write how we got that number. Here we say we used sales as what we're projecting as, and the number was 70% for this case. And then everything else that follow the same rule, SGA, other expense, we do the same thing. Here we have 12%, 6%, and then we take these percentage and multiply by the 55,000 because this is the new revenue figure. Also in this case, we have CapEx following that rule. A negative sign here in the CapEx means that you're spending that much money because this was taken from the cash flow statement, but the idea is that you're spending this much money. So don't let the sign confuse you for CapEx. Yeah, just keep it negative. The only reason this is kind of off on its side is that CapEx you don't really find on the income statement. This is taken from the investing portion of the cash flow statement, and there we use negative sign for cash outflows, but the idea is the same here. So again, sometimes it might be labeled as positive value just for the formatting, but the idea is the same, that you're spending this much money. So if it helps, just take the absolute value of that amount and say that's how much money is being spent. And just stay heads up on what's coming. CapEx, we're going to need this number to calculate the PPE. And especially when we get to that point, don't let the sign of the CapEx confuse you. No, CapEx is how much you're spending. You can't really spend negative amount of money on CapEx. It's always outflow. Balance sheet terms, same idea. Even though these are snapshot terms as opposed to revenue, we project it the same way, in the way that we would project the income statement values. So still use that 50,000 value we had before for this most recent year. So take the percentage of that and then take these percentage multiplied by the 55,000 number we have. So this is for all the assets, excluding PPE, because that it's going to follow its own rule. Liabilities, same idea. Skip the ones that have their own rules, in which case here is the debt, but everything else assume as a constant percentage of sales. So we do the same for asset, we do this for liabilities, but you don't do it for owner's equity because owner's equity follows its own rule. That on one hand, it's the difference between assets and liabilities, but on the other hand, there are three components of it: PIC, net income, dividend. And each of these three, we can figure out where they come from. PIC, in this case, we're trying to solve for, so there's no way we can project that. Net income, so remember, this is where the income statement and the balance sheet interact with each other. So part of this figure is the net income. To go from one period to the next period, we take the change in net income from those two snap moments. But the change in net income is simply the number from the income statement. So this is what we're trying to solve for. This is taking from the income statement. This, we're usually told what the policy is. Also say that we don't project owner's equity. The income statement takes care of part of it, and then the other ones have its own rule. So here, everything here we would project, but we leave this here alone for now. So anytime you have entire subsection complete, you can tally it up. In this case, everything was projecting as a percentage of sales, or in this case, this was constant, so you just take the same number. And if we have everything, we can tally up the liabilities. So that, we're one step done. Okay, so now we're going to go back to all those terms that we skipped out on, the more difficult ones. And you'll see they're a bit more difficult because you're taking a number from an income statement and a number from a balance sheet in some cases. So let's try depreciation. So we said depreciation is going to be affected by how much PPE you have at the beginning of the period. Not the end of the period, but the beginning of the period. And remember that depreciation is how much depreciation happened within a period, but the PPE is a snapshot. We're saying this much depreciation happened in the first 3 months of this year, given that we had this much PPE at the end of last year. So it's kind of similar to those ratio analysis we did, where you take one term from the income statement and one term from the balance sheet. And exactly like that, we have to make sure we choose the numbers from the right column. So for this most recent term, depreciation was 4,000, but the beginning of period PPE is 32,000, now 33, because you're taking the beginning of this period, which is the end of the previous period. It wouldn't make sense to take the depreciation from this term divided by the PPE ending this term. You have to do the start of it, which is the end of the last one. So that's why we have number from here, this column, and number from this column. So exactly why we said not 33,000, but actually we're going to use this number for the next period, because the end of this period is the beginning of the next period. So we're going to keep the same percentage, but we're going to take the PPE at the end of this period to get depreciation for the next year, which it's not shown here, but that would be depreciation here. So what makes this a bit more not as straightforward as the previous one is you have to make sure to take the numbers from the right column. So almost the same for interest expense. We take the interest expense as a percentage of debt. In this case, the numbers are all the same, but know that we're taking the 1,000 from this most recent period, but the 14,000 from the end of the previous period. And then it just turns out, because the number doesn't change, when we project it, the interest expense is also going to be the same. But you use this 14,000 here for the next period. So income before tax actually is a bit simpler than the last two, because tax expense and EBT are actually both from the income statement. So there's no need to cross over the period like the previous two instances. From the same column, you take the income before tax divided by the income tax expense divided by the income before tax, because both of those terms refer to a specific period. And similarly, you use that percentage to project your new values. So where are we at? Total revenue, that's the first thing we did. These numbers with the sales figure, we got them out of the way first. Depreciation, we used the PPE to project. We used the debt for the interest expense, and then for the tax expense, we used the period's income before tax. So now we're onto this new period. We have this number. We have the cost of revenue from the first run. Same with these two numbers here in the white cells. The numbers here into the two yellow cells we calculated using their own rules for the depreciation and the interest expense. So now we have all this. we can get a subtotal for the income before tax. Because you need the income before tax to get the tax expense. And once you have the tax expense, you can find the net income. So income before tax, or earnings before tax, EBT, to get to this number, you need to have everything upstream of it, which once we get depreciation and interest expense, we are able to do that.
So before we got to 50%, where was that?
So we haven't done anything with 50% just yet.
Okay.
Once we have the income before tax, 50% of that's going to be the tax expense, which I think is the next slide. Yep. So this 50% of the tax expense, we can use this once we get the income before tax for this current period. And then once you have the tax expense, you can subtract that from the EBT and get the net income. So with that, the income statement is finished. We were told that dividend and PIC would be 0. So no dividend is paid during the period. No PIC is, well, PIC we need to solve for. Dividend, there's no dividend. When we say there's no dividend, we mean that there's no dividend paid during this period. It's not to say the dividend figure on the balance sheet, which is the cumulative dividend paid across time, is going to be 0. We're only saying for this next year, there's going to be no dividend. So one more thing we need to do is, so remember, liabilities we had it all done. Assets, the only thing we needed to do was the PPE. So PPE follows like this. You have some PPE to start out with at the beginning of the year, or any beginning of any period. And then during that period, you purchase some PPE. That amount is your CapEx. So earlier we had the thing with the negative sign, the positive sign. Well, here, how much ever you paid for, or how much ever equipment you bought, that's going to be added onto your PPE amount. So you add a positive number. This is how much more equipment you got. And then during the period, you buy some equipment, and then some things wear out. That's your depreciation that you subtract. So these two terms refer to the changes during the period. So if you have a beginning amount, you buy some new equipment, you wear some out, you end up with the end of period PPE. So even if the CapEx is negative again, we add the positive amount, the absolute value, because that's how much more equipment we're having in our system. So let's do it here. The beginning of period is 33,000. When we're looking at this next year, we have CapEx here, 5,500. We're going to add that. We got this from projection earlier on. Depreciation we projected with its own rule earlier, and it was 4125. We're going to subtract that. So if you have the beginning, add how much new stuff we have, subtract what we're out, that's how much we have at the end of the period. So this is where these three numbers are coming from. So once we have PPE, we can add up all assets, and we're almost there. Yep. income before tax. This was, yeah, so we get income before tax by subtracting all the costs from revenue. All the cost minus, except for the tax expense, because that's what we're going to do next. So we added up all the assets. We already have the total for all liabilities. So just given those two numbers, we can know the equity figure. But this figure, again, it's on the balance sheet. So this is the cumulative equity of this company at this point in time. When we got this number by subtracting the liability from the asset. So at this point, there are a few things we can do. One thing we realize is that we have some equity at the beginning of the period, and we have some at the end of the period. And recall that we're trying to solve for PIC, which is a component of the equity. So the first thing we can do is to actually see that, because we have this new equity figure, we have the beginning equity figure. So that means there was a change in equity during the period, which is simply the difference between the next period and the current period. So we got this number with the new assets and liabilities. And once we have the end of period equity, we can take the change in equity by taking the two numbers on the balance sheet. So this 2275 is the change in equity, but we also know that it's also equal to this. Because if we just take away all the deltas, that's an identity. And what do we know about this here? This is what we're trying to solve for. We know this already from the income statement. We're told that this is 0. So we know this. We're trying to solve for this. We know this and this. So at this point, it just becomes one unknown and one equation. So this is putting it there. You get the net income from the income statement. So here we've been working with the balance sheet to get the change in equity, but this term comes from the income statement, and this is where these two financial statements interact. Well, it's one of the places they interact, but this is the place where they come together at the end. So this is the only thing we need to figure out. Just solve for it, and we get 1538 rounded, which is what we've been trying to solve for. And that's it. Interpretation, if the PIC in this period is this number, that means they have to raise this much equity to maintain the growth. So remember way earlier we said the sales growth is going to grow at 10%. Well, this needs to happen in order to make all the other assumptions we made hold true. So we would have finished this. You could do the same thing for the next period to figure out what the number would be. Okay, so we more or less did a problem to figure out how to do the projections, and hopefully with this you remembered what it means for a term to be a snapshot term versus a period term. And where they really came into play was at the end here, where you have this number 28,000 and this number the 3275. These are both snapshots, but if you take the change of them, then you get a period term and so forth. So the rest of this is going to be a breeze through the other topics, like time value of money. You've had problems on the homework with this. There are a few equations, but in the end, it boils down to these equivalent equations. Everything is more or less derived from this. So I would say try to, if you memorize a formula, remember these ones. All the other ones, rather than memorizing what they are, if you know what they do, you can derive their meaning from these basic formulas. And this is all to say that you have a present value compounded at a rate of r for t periods, and you get the future value. So in a lot of the homework questions, I think one of the biggest challenges is to figure out if the numbers that you're given, if they are present value or a future value. So when there are homework problems that say there's a stream of payments that say payment of $100 for the next 5 years. So if there's going to be a transaction of $100 for the next 5 years in year 1, 2, 3, 4, 5, that 100 is all future value. Because in a year from now, $100 worth of transactions will take place and so forth. Present value is when you discount all those future payments into the present time. So this equation is simply a rearrangement of the first one. And this is the one you probably use with the most, but all this is a rearrangement of this, where you take the future value, you discount it to the present value. And this NPV equation is an extension of the second equation by summing up all the cash flows. So when we say cash flow, again, they are the future cash flows. Whether it's you who's making the payments or receiving the payments, those are done in the future. So all the amounts that you pay or receive in the future are future cash flows. And if you take all of them, well, if you discount each of them and then add them up, you get the net present value, which is the metric you use for most of your calculations. Question?
Yeah, what's the format of the test going to be? How much, like what percentage is the time value of money?
You have one example of performance projection, and then you have a series of small questions with time value of money. So it's not a one big question, but maybe say 5 or 6 smaller examples. And then a few other concepts mixed in there that are also in the smaller, like small questions.
Are there any qualitative questions?
There could be a few in like the small questions sections, like 1 or 2 questions. There are small questions on that topics. Yeah. Project valuation, that's just an extension of what we said here about once you get the NPV of projects, then everything we talked about with the whether or not a project is worth pursuing. Make sure you know these terms. What does it mean to have a capital budget? Mutual exclusivity, equal length. Capital budget just means how much constraint you have to do the projects. If they cost too much to start out, you can do all of them. Mutual exclusivity, it means if you choose A, you can't choose B. If he doesn't say it, then it's assumed that they're not exclusive, that you can do A and B. And equal lengths, that comes in when you're evaluating multiple projects and seeing which ones are better. And the idea is that if you have no capital budget, you're free to spend on any of the projects you find worthy, and there are no mutual exclusivity, so you can choose everything that you want, then you want to choose all the projects that give you a positive NPV, given this formula for the NPV. Because positive NPV means that it brings you positive wealth today by pursuing this project. So if you have unlimited money to put for the initial cost, and that you can't choose all of them, then why not choose all of them that give you positive wealth today? If there is capital budget constraint, all you're gonna do is, in an exam, the numbers will be simple enough that you just look at the initial cost, and then you're still trying to maximize your NPV, but now the only constraint is that your initial cost cannot be more than the constraint that you have. And again, like the numbers will be simple enough for the exam that you won't need any software. If they are mutually exclusive, so you have project A and B, you can't do A and B. You can only do one or the other. If it's equal length, then you just choose the higher NPV. But if they are unequal length, then you have to choose the one with the higher equivalent cash flow. And that is just going to involve one more step of calculation once you get the NPV. So you would first calculate the NPV for both of them, and then if you realize you need to calculate the CFEU because they're different lengths, then you take the formula for the CFEU requires that you have NPV first anyways. So hopefully this is a useful chart to figure out what's going on here. If you have capital budget constraint, then automatically you're trying to figure out how do you maximize your NPV given the constraint you have. You have to play around with the combinations of them. Otherwise, then the question becomes, are they mutually exclusive? And if they're not, then this is the easy case where you just choose it if it brings you positive wealth. Otherwise, if you're forced to choose between alternatives, then you look for whether they're equal length or not. And that's it. So let me know if you have any questions.